Alrighty, so welcome everybody back to day 12 of the 30-day Traders Induction here on the channel. Today we're going to be diving into some basic market fundamentals. So to begin with, what are market fundamentals? When we're referring to market fundamentals, we are referring to the collection of key factors that influence the overall direction and behavior of the financial markets relative to the real world. So when we're reading a price chart, these are kind of the effect, if you will, of all of the outside market fundamentals that push and impact price in whatever way it's currently moving. So the price charts and the technicals just refer to and reflect the exact valuation and what it's done historically, whereas the market fundamentals is the main cause of that cause and effect relationship in the asset. So some key factors as to what make up the market fundamentals as the umbrella term, if you will. We've got economic indicators, so they are the key data points like GDP, inflation, employment reports, interest rates that reflect the overall health of an economy. So the economic indicators are the main point that we're going to dissect a little bit later on in this video, as the primary source of all of the data points that actually influence the market on a specific level, whereas the rest of these factors are a bit more of like a general principle, if you will. So supply and demand is the relationship between the availability of assets or the supply and the desire to purchase them, which is the demand, with which influences prices. So supply and demand is the battle between people wanting to buy and people wanting to sell, if you will. So markets going up and down. So up and away from supply and up away from demand. Then we've got central bank policies. I'm going to I want to make myself a little bit smaller actually. There we go. So central bank policies are decisions made by central banks like interest rate changes and quantitative easing, which affect market liquidity and sentiment. So these a lot of these ones you'll find coming out in the more of the presentation report style announcements that they make, and also in the news. These the policies is quite entangled with the politics and the news networks, if you will. Moving on, we have corporate earnings, so performance reports from companies that influence stock prices and broader market trends. So these are the earnings reports that come out on I think it's a quarterly basis, that can directly reflect within the price charts. Geopolitical events, political and international events that can create uncertainty or opportunity in the markets affecting the movements. For example, the wars going on at the moment. This is sending gold through the roof because all of the different events around the world are just pushing money into different markets based on where investors want to seek riskier investments or seek the safe havens. Market sentiment is the overall attitude of investors towards market conditions, which can be bullish as in optimistic or bearish as in pessimistic. So the market sentiment is a word that we can use quite naturally when we're looking at a price chart, especially because we can see the market maybe making lower lows and lower highs, which we can gauge a bearish or pessimistic market sentiment. You can also see it in the news reports or Twitter, for example. You can see that people might be screaming Bitcoin to all-time highs, so they're very bullish and very optimistic as a market sentiment, or on the inverse, they can be very pessimistic and they've got a bearish sentiment. So it's about gauging the collective psychology, if you will, or the sentiment or the emotional value of the wider range of traders. So the economic calendar now is where we're able to grab a hold of all of the information within the economic indicators. So this is the primary bit that we're going to cover. And the economic calendar of choice is forexfactory.com. And as you can see, we have a nice little table view of all of the information we could possibly ever need, all in one resource that can help us identify what's going on in the world that may affect the markets. So it's a tool that displays scheduled economic events. It lists important data like the interest rate decisions, employment reports, and GDP releases. And it's used by traders to anticipate market movements. Now, I'm going to dive into this a little bit more in the next couple slides, but it's basically a tool that just allows you to see what's coming up in the future. It's a calendar, and it's very important that we're on top of looking at what's up ahead. Not so much exactly what it is or what it means, but more so being aware of it occurring at this specific time of the day. Because when we're looking at the price charts, we're not able to see these things coming up ahead unless we're using something like a calendar that can be indicative of increased volatility, again, which we'll cover in a second. So how to use Forex Factory. So you jump into Forex Factory here, you load up the screen, and then you firstly just want to click this button here with a little filter, and that'll open up this prompt. And what you want to do, and what I personally do, is just filter by the red high impact economic events. I don't really care about all the small little ones on the whites, the yellows, and the orange. They're there if you want to look at them, but they're very low impact, so they don't really move markets or do a whole lot. You can select the currencies that you want to look at, and then also the event types. You can filter it down. So sort it by this week so that you're only looking at a week ahead. And that will list exactly as you can see here, just all the red. So on the left-hand side, you have the time and the day. You have the currency, the impact, which is the red, the high impact. And then you've got the event itself here. And then you've got the actual figures for the ones that have gone. You have the forecast is what they're anticipating ahead of time. And then the previous is the previous actual data that was dropped. So this is how it's all used. Now, how to use it, once you've filtered it and you've got that list of all the events, what you can do is you can click this little button, which is like a little folder, and it'll open up a whole source of information on what this event is. So myself personally, I don't really know a whole lot about the market fundamentals of the specific events and what they mean and how that affects the economy on a day-to-day or longer-term basis. But it's sometimes nice to just go in there and know what it is that you're referring to. So you see CPI, it's a red high impact event for the US or for the Aussie. You know what's going on, because it's very often spoken about in the news. So sometimes it's good to be aware of what's actually going on in the world from an economic standpoint, especially when we're trading currencies. It's very important. It's a very important factor, but not necessarily required in order to be trading the markets. So you get the source of where it's from and what it measures. So, for example, the change in prices of goods and services purchased by consumers, and then actual greater than the forecast is good for the currency. So we'll go over that in a sec. But it tells you all the information. It gives you some news articles, and it also gives you a history of what's happened in the past. So first, you want to filter it by high impact. Second, you want to be aware of the upcoming announcements. I check this on a daily basis, once a day of the day ahead. So going into Asia, which would be midnight London, I'm looking at that next day, what's going on for the next day. Do I need to be aware of some high impact news coming out at 1 o'clock tomorrow? Maybe I don't want to execute a position at that time as it's occurring. And then you can read into the information of what it is. Not required, but cool. You can also get the line charts. This is where I geek out. I love my charts and I love stats and data. So when you click on this little button here, which is the little tower button right on the right hand side of the view, it opens up this chart, which is where you can actually see what's been going on. So a lot of people these days are talking about, oh my god, interest rates are so high, what the fuck is going on? But you can jump on here, look at a line chart, and see actually we're just trading, or we're just at that same point where we were maybe 4 or 5 years ago, and that we can see that the markets and these types of events and principles and data points actually occur on a cyclical basis. We reach them and then we move away, and we reach them and we move away on a continued basis. So it's all about the timing. Now, interpreting market economic data. So better than expected will likely cause a bullish market reaction for that specific currency. And then worse than expected can lead to a bearish sentiment. So it can make the markets move up, or they can make the markets move down based on whether the figures have come out better or worse than expected. And in terms of market expectations from a technical perspective, we can actually look to see how the market prices all of these in advance. So when it comes to that final topic of using it, seeing that the market prices it in, we can actually use the fundamentals on our trading, not necessarily for an indication, but some people do. Some people do trade based on the figures, and they will wait for the announcement to come out. It's come out better than expected, so I'm going long. And people do that. They're fundamental traders. It's not really the purpose of this entire course. It's not the area of trading that I'm personally involved in, but there are fundamental traders out there that trade based on the news. For myself personally, however, The news creates the volatility, not necessarily the direction. So this ties back into my last point where I was saying we need to be aware that at 1 o'clock there's CPI for the US dollar coming out. This is a big event that happens, and if we're not aware that it's coming out, we could be executing into a position a minute, 2 minutes before this news release comes out. Spreads go through the roof, mass slippage, mass price spikes, and volatility, and suddenly we're risking 1%, but we're actually down 4% on the close because of slippage. It's very, very dangerous to execute in a market when we're not aware of the upcoming economic announcements, because you can see it on the charts that the wicks, like all these wicks, crazy wicks and crazy big bodies, these are the result of these economic announcements coming out. There are definitely ways in which you could gather data and statistics on what's been happening to form an edge and how to trade that market through that safely, but just myself personally, it's just not the area of trading that I am personally involved in. So I'm not going to speak too much further on that. But news creates the volatility and not the direction. What you'll often find is that the markets, in advance of the economic announcements coming out, the markets in the technical price charts and the patterns that you see actually price in what's going to happen. Now, that doesn't mean that you can see what might happen because it's a double bottom. You're looking for it to go long, so therefore the result of the data drop might be better than expected. But it's an indication. Generally speaking, if you're looking at a price chart, you've found a pattern, an edge, if you will, your setup has presented itself. Generally speaking, if there's an economic event coming up, it's going to move in the direction that you were anticipating, but it's just going to be a lot more volatile and a lot more risky to execute going into it. So moving on, we've got, it's good to be aware of when increased volatility is to be expected. Again, you just don't want to be caught off guard by these things, because there can be some crazy announcements and crazy shit going on throughout the economic releases, and you don't want to be caught unaware of what's going on in the surroundings, because it can cause some real damage to the account. So now, in summary, today we have covered what the market fundamentals are, and market fundamentals are like the umbrella term of all of the key factors that impact all of the price data and all the fluctuations in the markets. Some key factors, the primary key factor that we're looking at is the economic indicators, which is like the GDP and the CPI. They're the ones that affect the market. They're scheduled ahead of time, and we can be aware of them within our trading routine. Then you've got other things like geopolitical occurrences, which is underneath the umbrella term of market fundamentals alongside the economic indicators, but refers to the events that are happening in the world that can affect the markets. The economic calendar of choice, Forex Factory, and how to use it. So you want to filter it by the red high impact. You want to be looking at the time, the currency, what it is, have a quick gauge on what the actual announcement represents and what it is. So the cost of the CPI is the cost of goods that people buy, whether it's going up, whether it's going down, and we can look at the historical data of where it's been and where we can make predictions on where it could be going. I don't know if it works in the same way as a price chart with like support and resistance, but I don't see why not. Interpreting market data, so this economic data, so if it's coming out better than expected, it's probably going to go up. If it's coming out worse than expected, then it's probably going to go down relative to the currency, and we can trade based off of that. But we don't trade off of that. We are aware of how the market fundamentals impact the markets from a timing perspective of when to be in or not, when not to be in, a few minutes around the increased volatility. That's the key factor of what I'm trying to say. It's probably the most important part of the whole module of today, is that we need to be aware of when the announcement's coming out, because increased volatility can be expected, and that's when we want to be preserving our capital and making sure we're not putting ourselves in a risky business where things can go AWOL. So today was basic market fundamentals, and tomorrow, day 13, we're going to be covering one of my favorite topics, which is trading psychology. So stay tuned for that. I hope you enjoyed today's video and took away some value. If you did, please drop a like, please leave a comment and say that you've enjoyed it. And I hope you enjoyed. Thank you very much for your time, and I shall see you tomorrow for day 13. Bye-bye.